Hello and welcome to the ninth episode of Bazaar Ki Baat. June was an extraordinary month for the Indian equity markets. Both the large cap indices posted very good gains. If you remember, for a couple of months, even in the recent past, we saw even while the large caps were doing okay, the small and mid caps had been lagging behind their peers. The trend seems to have reversed over the last 2 months. Both the mid cap and the small cap index has risen above 6.5% in the last month. There have been concerns around Fed's future rate hike trajectory, but I think that did not dampen the US markets at all. Both S&P 500 and Nasdaq 100 continue to have post gains across the board. Shithar, I would like to invite you here. What's your view on the overall market? What is triggering this rally? And what do you think is really happening across the board?
Yeah, hi Shruti and hi everyone. So in the last 3 months, if we see Nifty 50 has risen almost 12%. So the reason we have been talking about it in the last 2 months also. The reason is simple. It's the deluge of FPI investment which is coming in. So FPI were infused around 5.7 billion in June, and put together this year we are up around FPIs have infused around 10 billion into Indian equities. So in this calendar year. So that marks an amazing turnaround of sentiments. So we were seeing FPA outflows almost throughout the year in 2022, but now we are seeing a sharp inflow. And so, considering this rally, now that the valuations have become reasonable from attractive in the last few months, but remain considerably below the highs of 2021, which we saw in 2021. So Nifty trailing P is close to 22 at the end of June, as in the last month, and we started the year at 21p. So not much has changed, and because the earnings have also risen. So from that perspective, the valuations are still in the reasonable zone. On the macro front, I would say we would need to watch how rainfall spreads across the country. How if we are able to have a normal rainfall this year, because if the rainfall is deficient or below normal, we may see a price spike, and that is a concern, right? Because the but if we see the rainfall is catching up across the country, and a large part of the country is still i- under the normal rainfall, but with only I think few states remaining under deficient. Sorry, so there are no states where there is excess deficiency. There are states where the rainfall is deficient, but we are the rainfall is catching up fast. From a deficiency of around 33%, we are at 9% now, below normal. So the rainfall is catching up fast. On the other hand, one big concern for the market, as you pointed out, was the hawkishness of the Fed, and market actually took the rate pauses as a peak of the hiking cycle. And now there are predictions that the Fed may hike two more times in 2023. So which has surprised the market across the world. I think the all the market participants in the first half were of the belief that that we have the rate cycle has peaked, but now we are seeing that the rate hikes are also being priced in, especially on the fixed income side. And if that continues, we may see some bit of correction in the market. Yeah, that's it.
Right. So I think the three key takeaways from what you have said is that market valuations have moved from attractive to reasonable, but they continue to be below the high that we have seen in 2021. Monsoons, of course, very important for India. And we need to be on a watch out for what happens to the US market interest rates. But looking at the sectoral, dispersion of returns, we see that, we have seen extremely good performance from industrials, healthcare, also, capital goods and also auto. Whereas if we look at, energy, IT continues to relatively underperform, FMCG, even oil and gas. I mean, all of these sectors still underperform, although last 1 month, all of them have posed positive returns. When we look at the equity strategies, we see that all of the strategies have posed gains, but momentum continues to lead the pack. So, what is your view on the diversion that we are seeing in the sector performance, also on factor strategies? What do you think is on the play here?
So, as you said, the major gainers for us across the sectors have been the industrials, capital goods, realty, and auto. If we see the YTD performance till 2020 in 2023. On the other hand, oil and gas, energy, power, utilities have underperformed. So, so if we see at the small cap stocks in automobile and auto ancillary sector, they have also performed well. So the reason is there is so much positive views about the auto sector that even the ancillary sector is doing well. And we are seeing a lot of those companies making all-time high in this bull run, right? And on the other hand, we are seeing most of the experts in the market remain bullish on the capital goods sector, given the government's thrust on infrastructure and boost to local manufacturing, right? So capital goods sector in specific has been a big beneficiary of the capex cycle recovery. Now, for investors, one thing to note is that there is a broad-based sector participation in this bull run, right? So, new themes and spaces like engineering, defense, EMS, healthcare, capital markets, there are some good companies there, and we are seeing these sectors have tailwinds. So they what it does is that as these sectors do not form a large part of the indices, it gives us a opportunity to outperform, right? Because these sectors, if sectors take leadership over IT, banks, or companies like Reliance, then we have an opportunity to outperform the indices because the indices are so top heavy with banks and IT making the large part of the indices. And as most of the market participants expect, bank NIMs have seemed to have peaked. And also on the IT side, we know for a fact that there is slowdown in the global markets. So ITs are also struggling. So if these new sectors come up and take up leadership in this bull run, then there is a strong chance for market participants to outperform the indices. So that's it.
Interesting. I think that's a very interesting perspective of new sectors emerging as on leadership positions, at least in the near future. Kshitij, one of the things that a lot of our clients and a lot of our friends, colleagues have been asking us is that we are at an all-time high. For after a long time of 2 years of time correction, we are witnessing a little bit of a bull run in the market. And one of the big questions that people keep asking us is it a good time to enter the market? For somebody who is sitting on, let's say, cash right now, should he enter the market with his money at these levels? What do you think?
So one thing is that we need to be clear about is the markets or indices are nominal index, right? So the Nifty 50 is benchmark it expected to rise if the country is growing. So if there is inflation and there is real GDP growth, then as a nominal growth of the country is anywhere close to 10 to 11%. So the Nifty 50 index is expected to rise at least by that much. So if it rises more, well and good, but at least by that much, we are expecting it to rise. So the market is expected to hit all-time highs every now and then. So that is the part of the journey. Our view is that even rising equity markets give enough opportunity to generate returns, right? So it is not a great idea to sit on cash and miss the rally just because the stock market has touched a new high. We looked at data, like I think we're already showing that from January 2000 to present, and checked if investors are worse off while investing at all-time high as compared to other days. So we have hit all-time highs around at close to 418 days as in all this 23 years. So we do not have a big sample of all-time high. But whatever comes out of it is like firstly, one thing which investors should note is the 1 year return for an investor investing at all-time high or any other day are not so different, right? So the differences comes only in the longer term, and that too because we are taking an average, and the average is skewed by the fact that somebody might have invested in a crash, like something in 2008 or 2020 for that matter, or let's say somewhere in 2018 when we saw the small cap drawdown, right? So that's one thing. Secondly, even if you invest at all time high, chances of you earning good returns are quite high. By good returns, I'm saying anywhere close to 8 to 10%. So when we look at the numbers, it may surprise you, but the probability of generating more than 8%, including dividends, right, while investing in Nifty 50 over 5 years is close to 70%, right? So it's not, so in summary, like I said, our view is that you should, it's not a great idea to sit on cash and miss the rally. It's always good to spread out your investments and keep investing regularly. That's the because the markets will hit all-time high every now and then.
Yeah, so I mean, even I have seen that every time we have a new all-time high, which is higher than the last high. And I think one thing that is of importance here is that there's in 2020 especially, what I saw is that there were people who were, after the rally, the post initial after the drop in April, when the rally happened in June, July, there were so many people who were waiting to enter at a deeper correction, and they couldn't enter the market because the markets just started rallying, and then it reached a new all-time high, and all of those people ended up regretting not entering at the previous all-time high. But one thing that a lot of people, even at that time, asked us, and even now that they're asking, is that should they be looking at uh, booking some of their profits, selling some of their, let's say, mutual funds or stocks, and maybe enter at a time when the market goes down a little. Is that a strategy that people should be thinking about?
So one of the best ways, I think, to answer that question, that if you should sell or discontinue your investments in equity at an all-time high, is to find out how justified is that fear of fall every time there is a rally in market. To get some perspective, let's say the chances of negative returns over 1 year are only marginally higher when you are investing at an all-time high than at any other time. So while the base case remains that there is still positive returns, right? But the negative returns are only marginally higher, right? The chances are only marginally higher. Therefore, the equity markets do not necessarily witness a correction at every all-time high, right? If so, as we have seen, the highs are not notably worse times to add capital. Selling existing investment makes even less sense, right? So if we consider dividends, even if you had invested only at all-time highs in during the past 20 years and stayed invested for 5 years, you would have still earned a positive return 100% of the time, right? The data above shows without dividends, but if you had kept dividend, that number goes to 0%. So there is no chance of us making a negative returns if you would have invested at all-time high. So I would say for investors, the better way to look at it is that you look at focus on asset allocation. You need to make changes in your portfolio after a significant correction or a rally, but these changes should be in accordance of your target asset allocation. So when there is a rally in stock market, check if allocation in equity in your portfolio has risen. Because if your portfolio allocation in equity has become larger, then there are more chances that it has become more risky and more volatile as compared to your target allocation or as per your comfort. So in that case, your investment strategy should be to rebalance and bring it back to the normal original level, right? So that is the way to look at it. Selling or exiting may not be the best thing to do at all time. That's where
Right.
I believe.
So I think the takeaway from here is that, it's not a 0 to 1 kind of a, decision, that whether I sit in
Right.
all cash versus whether I'm all in equity. We need to look at rebalancing. There is scope for rebalancing. We need to focus on asset allocation. And, we need to understand what is our long-term game in the markets. Why are we in the markets, and what kind of returns can we realistically achieve in the markets? Because I have seen that in trying to time the market perfectly, most of the time we are actually, as investors, irrespective of what the data is showing, investors tend to underperform even the numbers that all-time highs show, because nobody can predict really where the market is going to go in next 2 weeks, 1 month, or 3 months. uh, so thank you, Kshitij. Thank you for your insights. We will now move on to our second section, which is on term insurance. If our viewers remember, last month we had spoken about how limited pay options don't make a lot of sense for people who are going for term insurance policies. I would like to bring in Vikas here to answer the second most important question around term insurances, that what is the ideal cover that you should have. We have seen in a lot of cases that people usually take a 50 lakh to 1 CR term insurance and they feel they're adequately covered. But what is the way to approach the question of what is the adequate cover for you? Because we want to give your views on how would you want to address this question.
Hi, Shruti. So, what I have seen is, like you rightly said, a lot of people think that term insurance of 1 crore is enough. So they have a figure in their mind and they take a term insurance. Or sometimes what happens is that there is a cat and mouse game between the insurance company whom you like, who calls you. He will try to sell you a higher cover. You may want a lower cover. So these kind of things are very prevalent. What I see when I talk to some of our clients or my friends and family. So, but I think so term insurance as a product, which we have discussed earlier, has a specific purpose. It is an expense which we are doing to meet an objective. So we have to think it in such a way that there's a proper objective that we are trying to meet from this expense. And if we start thinking on those lines, then maybe we can navigate this scenario about how much term insurance should we buy. So what I have seen is that insurance companies, when they want to pitch a product, they will say that we can offer you close to 20 times your annual income. So say suppose anybody having a 40 lakh income can be offered a 8 crore cover. So the point I'm trying to make over here is that you need to assess what is your requirement. So the first of all, the important thing is that term insurances should not be based on your income, but it should be based on your expense. That what is the expense that you want to underwrite or you want to replace with term insurance. Also, what happens is that term insurance generally is not a standardized product. Each individual may have his own financial responsibilities. A single household individual may have certain higher responsibilities than a household which is having a dual responsibility, like dual income earning opportunity. So again, when you are buying a term insurance, you cannot just think that my friend is buying this term insurance, I should buy the similar kind of cover. It is again not based on just income, but also about how you are placed in your financial life and your responsibilities. So these are the starting point which you have to think when you buy a term insurance, and you have to try and think that how can I replace my income with the term insurance. So these are the things I think if you start thinking on these lines, then you will actually hit the right number of buying the term insurance rather than thinking something else. So just to, this is again a small hypothetical example that we want to discuss so that you get the thought process behind buying a term insurance. So if say suppose we take a small example that there's an expense of 1 lakh which a household is incurring. Say suppose he is a single earner in the family. Housing loan, he's having a housing loan of 50 lakhs. Sometimes what happens is that housing loan has a separate term insurance. Again, this is case to case basis. If you have a housing loan which has a separate term insurance, which means that if something happens to the housing loan applicant, the term insurance which is to the housing loan pays the term housing loan. So if you have that, then this has a different calculation. But if you don't have, then it has a different calculation. In our assumption, what we have assumed is that housing loan is not covered with a separate term insurance. What we have again taken example is that the household is having a child and the education goal of the child is still not fulfilled with the income. So they are just starting their like financial planning journey. We have assumed inflation and FD rates at same for ease of calculation. We have assumed that right now the family has not accumulated any corpus and the interest that they receive from their investments is assumed as zero. Again, for ease of calculation, this can again change the numbers a bit. So with this assumption, when we do the calculation and with the thought process that I had shared earlier, what we see is that if you want to replace the income of 1 lakh per month, you need approximately 1.7 crore of term insurance. Now with this term insurance, what happens is that if say suppose something happens to the bread earner, the entire income which was like the entire expense that the family was incurring will be easily replaced with this term insurance. So the actual purpose of the term insurance is fulfilled only if you are buying an adequate term insurance. So a lot of times what I see is that people think that 1 crore is enough. So they'll say that buy me a 1 crore term insurance. I think that is enough. So you have to understand that you are underinsured if you're buying a 1 crore cover, and for adequate insurance coverage, you need to actually work out the numbers. Then, if you have an uninsured housing loan, that should ideally be added to your term insurance cover so that something happens that the housing loan liability goes out. Unfunded long-term financial goals can also be added, which can help you be more financially secure, and the person, like the family, may not have the burden when these kind of big expenses come. So if we take these kind of assumptions, the cover which is required is 2.45 crores. And if you want to keep a buffer, and buffer, so the reason for keeping a buffer is what can happen is that we may see interest rates going down, or you may see some or other like medical expenses which may come into the family. So keeping a buffer, again, a buffer is a very subjective thing which you need to discuss with your planner, or you need to think yourself that what kind of a buffer I want to keep. It can be 10%, 20%. So with this kind of calculation, an ideal cover may be 2.7 crores, which I may be comfortable. So what I'm trying to say is that you have to think on these lines.
Interesting. I think
So
that makes a lot of sense because looking from an expense need analysis basis makes a lot of sense. And in some cases, and I've seen that if you go by thumb rules of X times your income, sometimes in double income families, the other person who continues to earn is very sufficient of taking care of expenses. So it's just unnecessary premium that people are paying for extra
yeah.
coverage, which is not required. So thank you so much, Vikas. I think that was very insightful. And thank you so much to our viewers for viewing this. Stay tuned for our next episode next month. Have a good day.